This is Al Brooks, and this is my price action trading course, my module on trading weak bull channels. Is a channel weak or strong? Take a look at the module on channels. Let's talk about a bull channel. Is it weak or strong? Sometimes it's impossible to tell, but it does not matter. If you cannot tell, only look to buy. Weak bull channel. Bull implies trend, which means higher highs and lows. Channel implies weak trend, and it occurs after the breakout phase. The weaker the channel is, the more likely you can take trades in both directions and make a profit. Weak channels tend to have broad swings, which means a lot of two-sided trading. If it's reasonably strong and reasonably tight, only look to buy. Only take trades in the direction of the trend, and don't worry about missing the sell signals. Is a channel so broad and so flat that it's actually a trading range? A lot of times it's impossible to tell, and a lot of times it's actually both a channel and a trading range. And it doesn't matter because you trade them the same. You buy low, you sell high, and you scalp. Most weak channels begin as trading ranges. So for example, here we have a trading range. Okay, you could also argue that it's a bear channel. We're forming lower highs and we had lower lows. And you can also argue that it's a bull channel because we now have a higher low. So it's a bull channel, it's a bear channel, and it's a trading range. It's a triangle. 3 pushes up, 1, 2, 3. Again, here is the triangle, and you could look at this as a bull channel or a bear channel. And right now it's both. It'll stop being one before long, but right now it's a bull channel, a bear channel, and a trading range. We have a bear spike, and you can argue that we have a bear channel. We have a lower high, possible lower low, and it's possible that this will end up in a channel. You take this line, you draw a parallel, and you anchor it here or you anchor it here, and that could be the start of a bear channel. So you can envision how this could unfold as a bear channel. But you can also look at it as a possible bull channel. We have a low and then a higher low. You take a parallel of this and anchor it up here, and this could be the start of a bull channel. And at the moment, we don't know which it is. Incidentally, you get a bear channel, a trend line break, and a higher low. So right now this is a higher low major trend reversal. So it's a swing long. However, it still could continue down as a bear channel. Same chart, and this is later in the day, and you can see what happened. We had the bear channel, the trend line break, the 2-bar reversal for the higher low, 2 big bear bars, so we needed a second entry, and they got it here. The market went always in long during this series of bull bars, maybe here or here. We finally have a higher high, and now we're starting to get a series of higher lows. So somewhere in here, it became clear to traders, especially here, that the market was in a bull trend. And so even though it was in a bear channel, and it was in a trading range, and it was in a bull channel, now it's only in a bull trend. So what do you need to see to think of a channel as a weak bull channel? Well, first of all, you need higher highs and lows to have the bull trend. And for the channel, you need big swings. You'd like to see signs of two-sided trading, signs of selling pressure in addition to the bulls being in control. So overlapping bars, weak follow-through after bull bars. So a bull bar and then a bear bar, a bull trend bar and then maybe another bear bar. Many bars with tails on the top. Some selling pressure showing that the bears are still active. You want to see selling into the close of some of the bars, creating tails on the tops of the bars. You'll see bars with bear bodies, so the market goes up and then it goes down for a bar or two. And you have obvious pullbacks, often with big swings. So sometimes it goes up a lot and sometimes it comes down almost as much. And it can have very, very broad swings. And it can end up looking like a trading range that is slightly tilted up. That's still a bull channel, but if it's that similar to a trading range, you can trade it like a trading range. Alright, at this point, what's going on? We have a 3-bar bull spike, a bear bar, a bull spike, some sideways, and another bull spike. So we have a strong bull spike, and now we're starting to get some selling pressure, so we may be in the process of transitioning into a channel. Okay, so strong bull spike here, less strong here, but within here we have sideways bars, we have some bear bars, we have a pullback below the low of the prior bar, we have a bull bar immediately followed by a bear bar, and we have some tails on the tops of bars. So we're starting to get moderate two-sided trading in here, and that's the hallmark of a channel. This is what followed. We've been in a trading range for about 20 bars, a 2-hour trading range, after a strong bull breakout, and it's probably either going to be a spike and bull channel day, or it may be a trending trading range day. We had our trading range here, a breakout, and we're forming another trading range here. This breakout is strong enough so that I think it favors more up. I think the market's always in long and probably strong to go higher. So what do? It's in a trading range for 2 hours, so you can buy low, sell high, and scalp, or you can swing part and bet that you'll get trend resumption later in the day. At this point, you have a push down and then a second push down, so you have a high 2 buy. You also have a double bottom with earlier in the day, and that also constitutes a high 2 buy. And now we have a 2-bar reversal, did not trigger, and then we have a bull bar closing on its high. We're in the bottom half of the trading range buy low, sell high, and scalp. We're low. We've been trading down for about 20 bars. You have to be looking to buy. And you have a decent enough signal bar after a 2-legged pullback. So this is a reasonable buy. So let's say you place a buy stop to go long 1 tick above the high of this small bull reversal bar. You'd get filled near the high of this bar. This is what followed. You got 5 bull bars here, a pause, and then a bull breakout to a new high with follow through there. So pretty good strength. So we have a bull breakout and 2 bars of follow through, and that's a sign of buying pressure. The bars are small, so the bulls are not all that strong, and we have tails on the top, so we have some selling pressure. Maybe we're going to enter another trading range, but at this point, it's a trend. It's a bull trend day. We just don't know what kind. Is it going to be a spike and channel, or is it going to be a trending trading range day, a lower range, another range, and maybe another range? All right. So we have another trading range here, a tight trading range at this point. Within it, we have a double bottom here and here, 2 pushes down, so that's a high 2 buy. And we have a 2-bar reversal here, so traders probably can buy on a stop at 1 tick above the high of this bar. Most of the trading for this past 3 hours has been sideways. If you take out this bar from the picture, pretty much the entire trading for 3 hours now has been sideways. We're just above the moving average. The prior pullback had 5 bars at the moving average. Pullbacks tend to get bigger and deeper, so chances are this will get down to the moving average. We have another bull breakout, but immediately reversed by a 2-bar reversal. So we have a spike up and 3 pushes, 1 being the spike, and then 2 and 3. Now we have a 2-bar reversal. And we probably will have to get down to the moving average because we did here. And you can draw this as a wedge top or a wedge channel after a spike. We'll probably get 10 bars to 2 legs sideways to down. We may find buyers here just above this gap. The market may instead come all the way down here to the bottom of the original channel. All right, we probably should get 2 legs sideways to down based upon the wedge top. You can argue we had 2 legs, 1 and 2, right? But it's only 4 bars. Yet the legs within the wedge itself were, each had 10 bars or so. So this does not look like enough of a correction after this big of a wedge. The correction looks too small. This looks like too small for a 2-legged correction. but you got two strong bull bars closing on their high, and to me, you're in a bull trend, and the market's trying to resume the trend, is trying to make the breakout fail. I certainly would get out of my shorts. Had I shorted this, I would have gotten out at break even or above this bear bar, maybe above this bull bar for a 2-bar reversal, or at the close of this bar for sure. Okay, I would get out either with a small loss or around break even. And this is what we have now. Okay, we have a bull spike with 3 small pushes up. 1, 2, 3. Push up and then down, up and then down, up and then down. We have a 2-bar reversal and a second entry short. Traders could short at 1 tick below the low of this bear bar. On the other hand, you can look at it and say, I don't know. We have a lot of bull bars all day long, and we're channeling up. We're forming higher highs and higher lows. Yes, this fell below that low, but to me that's not important. I don't think this was a major low. I think this is a more important low. This is just a tight trading range. Okay? Whenever a wedge fails, okay, a wedge, you should always look for 2 legs sideways to down. But as soon as the market got above its high, the wedge has failed. So the odds favored 2 legs sideways to down, and that means was less likely we got the breakout above the wedge. Anytime the lower probability event happens, you usually get a second leg. So we'll probably get a second push up. So I personally would not take this short, especially because these 2 bull bars are strong. We have another strong bull bar here. We have a lot of buying pressure here and a lot here. I would need, you can argue it's a high major trend reversal. We have a trend line, a bear break below the trend line, and then a rally. But the bear break was only 4 bars, and I think that's not enough selling pressure to erase the bullishness of the past 40 or 50 bars. So yes, higher high major trend reversal, second entry on the wedge. I would not take the short. And right now we have a triangle, 3 pushes down. First push down here or here, either of those bear bars. Second push, third push. To me, this is a breakout mode situation. And now we have a bull inside bar, IOI. To me, that's a reasonable bull flag buy for at least 1 more push up. It's a triangle, so it's a tight trading range, and it's occurring late in a bull trend. So it may end up being the final flag of the bull trend. And we traded up. This time the channel is we have a new channel, and we're getting small bars, some bear bars, more small bars, a bear reversal bar, a breakout trapped bulls who bought above that, another bear reversal bar. I would certainly get out of any longs, and this one I probably would consider shorting. We're starting to get a much weaker rally here. You can argue this is 2 legs up from the breakout above the wedge. You can say this is the first leg up and a pullback, and then that's the second leg up. And you have okay, so I think this is a pretty reliable sell signal. We're starting to accumulate selling pressure. The triangle, tight trading range, is a magnet. I think the odds are we'll get pulled back at least to the triangle. And we have a decent signal bar. Okay, you can redraw the wedge and say that this is a larger wedge. Spike, 3 pushes, 1, 2, and 3. And then within this there's a smaller wedge. The bears who shorted here, their stops are probably above the signal bar high. Some might get out above the entry bar because of the big tail, but I think it's probably better to have your stop above the signal bar. I'm concerned about this short. We haven't had big pullbacks at all today. It's many types of days. You can call it a spike and channel bull trend day. You can call it a trading range day. You can call it a wedge top, but I'm concerned that the pullbacks are not very big. And if I take this short, I want the market to fall very quickly, and that's not what it's doing. I personally would get out probably around break even in here. We're at the end of the day, and I want the market to fall quickly. I don't want to see these small bars and tails at the bottom, especially since we haven't really had a trend line break, and we haven't had significant selling pressure, certainly since right here. To me, this is not turning out the way I wanted it to turn out. But at the end of the day, I wanted a sharp sell-off. If we did not get it, I would just get out and let the day go. It's certainly a good location to take profits. You know, we're near the end of the day. You're looking for a reason to take profits. So traders who are swinging longs from anywhere in here, I think they should get flat below the low of this bear reversal bar at the top of the channel. Okay, the day, like all trend days, has features of more than one type of trend. You know, we have the spike and channel. We have a series of trading ranges, so it's also a trending trading range day. And the pullbacks are very small, especially since this low. So it's also a small pullback trend day, which is the strongest type of trend day. Okay, it's a weak bull channel. It appeared that it was going to have swings that were big enough to trade in both directions, but there were problems with all of the shorts. They just weren't good enough to take, except that last one. And you know, we did not get a big bear entry bar, and we did not get follow through. So it was not a very good sell setup. Most of the bull spikes were followed by trading ranges, so lots of two-sided trading, but the bears were never strong enough to push the market down very far. Buy low, sell high, scalp, but in this case I would only buy because the sell signals just didn't look good enough, and I certainly would buy at support like the trend line below or the moving average. Certainly take profits or at new highs and at resistance levels. In general, in this particular case, I think the only reasonable short was that last one, and I would get out after a couple of bars if it did not go my way very quickly. For a weak bull channel in general, where are your protective stops? In general, if it's a weak bull channel with big swings, it's better to scalp most trades, like in a trading range. And if you're only scalping, you don't want to allow pullbacks. And you certainly would get out below any strong bear bar or any strong bull bar. If you have a strong bull bar, you don't want the market to fall below its low. That bull bar is a breakout, and you don't want the market to reverse below the breakout bar on the very next bar or a bar or two later. The initial stop is below the signal bar. So for example, let's say you bought above the high of this bar. Your initial stop is one tick below its low. You could go for a reward 1 times the risk because it's a trend, and therefore the probability is 60%. If you wanted to scalp out, you certainly could. Your actual risk was probably to below the low of this bar, just just a few ticks, and this probably was 2 times your actual risk. If you bought above this bar and you were scalping, thinking that the market's transitioning into a trading range, you could get out with a reward equal to your risk. Same with over here. If you want, you could try to get 2 times your risk, but whenever the market's in a trading range, I tend to go for smaller profits. Even though we're sloping up and we're channeling up, most of the price action today has been most sideways. So, if I were swinging, I would probably only swing a small portion, and I probably would be inclined to scalp, most of the trades. Protective stops, if I were swinging, let's say you bought here, and the initial protective stop is below the signal bar. Every time you get a strong bull breakout bar, you could tighten your stop to 1 tick below its low. This is tricky. You could say, well, higher high, put your stop below the most recent higher low, but I would not do that. Here we had a wedge top with a bear inside bar. I would get out below that bear inside bar. I would not keep my stop down here. Here we had a lower low, right? But we still don't yet have a lower high, so we're still trending up. And instead we got a higher high. So once we went up here, I would trail it here. Once we get up here, I would just get out of longs. I think there's too much risk. We only have a few bars left to the day. Let's say you're swinging instead of scalping. Okay, let's say you bought above this bar and you went for a reward 2 times your risk. Okay, You take half off at 2 times your risk. You swing the rest. You might exit here below the wedge, 1, 2, 3, right? So the wedge is triggering with this bear inside bar, so I think you can exit the second half over here. You could buy over here and go for 2 times your risk, and you'd get out up here. And you'd take the second half off here at the reversal down into the close. If you were doing sell scalps, okay, you might short the wedge here, and you might go for part off at reward equal to risk. You know, you look at this and you say, well, the probability is 60% that you'll get 2 legs sideways to down. So if you have a probability of 60%, you could scalp out at a reward equal to your risk instead of going to 2 times your risk. Since you're trading against the trend and we don't yet have a major top, I would only scalp the shorts. Same thing here. If you do take this short, it's so late in the day, I think you need the market to go your way pretty quickly within the first bar or two. And if it does not, I would get out at break even. Although that channel had many features of a weak bull trend, the shorts did not work. Okay? When you have any doubt, you treat it like a strong channel, and you buy and you try to swing at least part of your position, and you only buy until there are clear sell signals. There was that one clear sell signal late in the day, and then that earlier one at the wedge, but neither one had a strong bear breakout, neither one had much follow through, and neither one had significant selling pressure before those sell signals developed. The broader the swings are in a channel, the weaker the channel is, the more the channel is like a trading range, and the more you should trade it like a trading range. Buy low, sell high, and scalp. If it's a bull channel, when you're selling, you could simply be selling out of longs. You don't have to sell into shorts. However, when you buy low, I think you should be buying for a trade, not simply exiting shorts. When it's a bull trend, you need to be looking to buy, even if it's a weak bull trend, one with very broad swings. Here's an example in the spider. We have a big gap down, but then a very strong reversal up. And at this point, maybe here or here, traders felt that the market was always in long and going higher. We had a couple legs down here, down, up, and then down. Traders might have bought above the high of this bar, maybe above the high of this bar, because at this point it's a micro double bottom. The market went down and up, and then down and then up. So, I think you definitely need to get long because it's clearly always in long after this strong bull spike. So you can buy above this bar or above that bar. And at this point, you have to wonder, are we still in a trading range, or is it going to be a bull trend? I think it's always in long, so I think it's a bull trend. I personally probably would not take this short, even though it probably ended up going down enough for a scalp. For me, the trend up was too strong, and then these 2 bull bars are very strong. So yes, a decent bear bar, and yes, a little micro double top. The market went down on this bar, up on this bar, and then down again. I personally would not take the short. However, I would take the long. 2 pushes down, 1, and then up, and then down again. Possible higher low, so I think that's a good long. Same problem up here. 2 very strong bull bars. Yes, a micro double top and a bear bar closing on its low, but I think too much risk of the market going sideways instead of down. So I probably would not take that short. I might with the bar closing on its low, but I would be much more interested in looking for buys. Here, at this point, we can draw some semblance of a channel, either based on a parallel of the line up here, or based on a rough approximation of what's going on with these 2 lows. We're near the bottom of it, and we have a bull inside bar. Buy low, sell high. Anytime the market's down 5 or 10 bars, it's low, and I'd like to buy. We're clearly forming higher highs and lows. Aggressive bulls would simply buy the close of this bear bar and put a stop below this higher low, betting that the bear attempt to break out below this higher low will fail. So aggressive traders, as soon as they see that bear bar, they'll say, wow, we're getting pretty close to this low. The bulls should come in pretty soon. And what better price to buy than where the bears are strongest, because they'll probably get trapped. Again, I probably would not take this short, a tail on the bottom of the bar after a very good bull bar and after a series of 5 bull bars. Up here, top of the channel, 2-bar reversal, getting late in the day. We might get a bigger pullback, 3 pushes up. I think that's not a really strong sell. We just have too much buying pressure in here. My preference in general, if I'm not confident about the counter trend trades, and if they're not perfect, I prefer in general just to go with the with trend trades. Again, another higher low. Yes, a strong bear spike, 4 consecutive bear bars, but we still held above the prior low, and we're trying to break to the upside. We have a high 2 legs down, 1, 2, and a 2-bar bull breakout, so a high 2 breakout, and then we have a pullback, and then a 2-bar reversal for a breakout pullback buy. I would take that buy. So for me, the buys look good. The sells, to me, look less certain. You can take them. This one, this one, and this one ultimately ended up being profitable. But if the channels are not very broad, and if the buying pressure is as strong as it has been all day, and if the sell signals are not absolutely perfect, my preference is simply to look to take the buys. Alright, so what's going on here? We have a bear trend, a trend line break, a higher low major trend reversal in the form of a double bottom, and then a 4-bar bull spike, and now we're starting to get higher lows and higher highs. Okay, are the pullbacks going to be too small to make profitable trades, or will the channel be very broad and will it be a pretty weak bull channel? At this point, we don't know. I do know that you can draw a trend line across these lows, and there's probably not enough room for a short here, despite this being a second entry short. So I probably would not take that short. And it turned out to be a high 2 buy in a bull trend. Bear signal bar, probably not strong enough for a scalp, not high enough probability for a scalp, but I do think you can take it for a swing and put your stop below the most recent higher low. Once you had this strong bull close, you probably could raise your stop to below the low of that bull bar. Here, another high 2 buy. The high 1 never triggered. The market went up and down, and then up and down. So it is a high 2. You can call it a high 1 if you want. You can call it a failed breakout of an II. We have an inside bar, bear breakout, and immediate reversal up. This is a short that I would take. II, possible final flag. We're near the top of the channel, a failed breakout above the top of the channel. We're testing the high of the day, and we have a pretty good looking bear reversal bar, and this is one of the best bull bars of the entire trend, so it could very well be an exhaustion gap, an exhaustive buy climax. So this is one I probably would short, at least for a scalp. Near the bottom of the channel over here, so I think you could argue to buy this for a rally into the close. With 7 or 8 bars down, I probably would wait for a second entry buy or a stronger signal bar, so I probably would not take that buy. Okay, is it a weak bull channel or a trading range? When the market's early in a weak bull channel, it's usually also in a trading range. So a weak bull channel usually begins within a trading range, and it doesn't matter which you call it or which will ultimately prevail until it clearly stops being a trading range. The best way to trade it is buy low, sell high, and scalp. Here's the daily spider chart. Okay, you can argue the entire chart's a trading range. You can argue that it's basically trading range activity here. Certainly from here, this could still be a trading range, and it's clearly forming higher lows and higher highs. So it's a bull trend, right? Higher highs and higher lows, reasonably big swings. So it's a weak bull trend. In other words, it's a channel, but it's also a trading range. You can begin to draw a channel line, and again, you might be able to short the new highs, but since it's a bull trend, I definitely want to buy the higher lows. So the market is in a trading range, but it's also in a weak bull channel with very broad swings. At some point, one side or the other will win. I mean, it'll either remain as a trading range, or traders will give up on the trading range notion and they'll conclude that it's simply a bull trend. Because it still is a trading range, you can buy low, you can sell high, and you can scalp. And that includes selling reversals after every new high. If you get a sell signal bar at a new high, you can sell below it. And if you even get a pretty strong bear close at a new high, you can sell it, especially if you use a wide enough stop, like maybe 2 times the range of the bar. So for example, we have a new high. See, every new high, it reverses. New high, reverses. Bear bar, reverses. A new high, bear bar, reverses. New high, bear bar, probably is going to reverse. You could sell that close, or you could sell 1 tick below its low. You would be filled on the open of this bar. This is a daily chart. And you want to exit somewhere around the middle of the channel, because you don't try to exit at the prior higher low, because the market keeps turning up above prior higher lows and the market probably will not reach down here. Since you're shorting in a bull trend, yes, it's also a trading range, but you're shorting in a bull trend, it's probably good to see if you can get 2 times your initial risk. So your initial risk is here, your entry is here on the open of this bear bar, and that would be your initial target. So as I said, you could either sell below the low of that bar, or you could simply sell the weak close of that bar. And then once you had this bear bar, you could put your stop above the high of this bar. Or at the moment that you sold this bear bar, you can allow for the market to go up a little bit more. Maybe put a stop in twice the height of the bar to allow a little bit more up before it turns down. And you're looking to take profits somewhere in the middle of the range. Which in this case I have the target 2 times the height of that bar in case we go down immediately, which we did starting on the very next bar. So here you'd be filled. And why does this have a bull bar? Because lots of traders bought at around 2 times the height of that bar. It also fell below this small higher low, and a lot of traders, when there's any kind of trading range activity, will buy below higher lows and they'll sell above prior highs. If you did have your limit order at that red line, the market opened below that red line, you would have been filled on the open. Again, this is a daily chart of the spider. Okay, so either a trading range or a broad channel. You could have a higher low major trend reversal after a lower low major trend reversal, and then higher highs and lows. And the market could still be trending even though it's still mostly sideways. You can assume it's a weak bull trend and buy above the prior low and scalp all above the prior high, scalp out of the entire position above the prior high. You could scalp out part at the prior high and then swing the rest and put a stop below the most recent higher low. If the market's below the midpoint of the bull channel but above the low, the most recent higher low, you can buy above the prior bar. You can buy the close of the bar if it has a bull body and just put your stop below the most recent signal bar or below the most recent higher low. Okay, on this bull bar here, you're below the midpoint of the most recent leg up and you have a bull body. I think you can buy that bull close and put a stop below the most recent higher low and go for a target maybe twice the height of the bar, which would be at a new high. Once the market turns up, you could do a measured move based upon the actual risk, which is below this low, or you can simply just take profits above the prior high. If you don't get filled at your initial target and you have a weak close on the bar, since you're at a new high and a weak bull channel and the market tends to reverse down at every new high, just get out at the close of the bar. Okay, here, excuse me. Looks like we're getting a strong bull breakout. You'll probably exit if you're exiting at the prior high. You would have been filled with this big bull bar. So let's say you exited half. You could swing the other half with a stop below the most recent high or low, thinking that if the market does pull down again, it will do like it's been doing all along and stay above the most recent high or low. If you entered later, if you instead of buying at the bull close in the middle of the channel, if instead you wanted to buy above the high of a bar and you kept placing buy stops above the high of the bar, so you placed a buy stop above the high of this bar, you would have been filled on the open. Okay, the risk is greater, so your risk would be below this low. With a bigger risk, you have to go for a bigger reward. It's probably still a 60% trade. 60% certain that you would make a risk, at least a reward at least as big as your risk, because it's a bull trend. So if you bought this open, in other words, one tick above the high of this bar, you would have been filled on the open. Your stop is below the low of this bar. Your reward, you'd want it at least one time as big as your risk, at least as big as your risk. So you could place a limit order and get out there. Again, since it's a bull trend, it's high probability, 60% or so. Okay, we're above the prior bar. You could exit on the close of this strong bull bar, just like strong bull bars up here led to reversals. Once you have a strong bull bar, you can make projections based upon the actual risk. So if you bought this close, your actual risk at most was below the low of the bar because the market went up immediately at that point. So your actual risk is from your open to one tick below the low of the bar, and 2 times your actual risk is that red line there. So theoretically, you could have taken partial profits at that red line, even though it's below the prior high. Okay, so we got a couple decent bear bars. All right, so what about buying up here? Okay, possible high or low. After those 2 strong bear bars, I would not buy. And what about shorting here? Let's say you decided, strong bear bar, another strong bear bar. Maybe I should go short on a stop below the low of this bar. If the market gapped this far down into the prior leg, I would not take that short. So at this point, I would be confused and I would wait. I could not short this far down, and the setup is not strong enough for me to buy yet. So when you're taking sell signals in a bull trend, even if the bull trend is in a broad channel, I would only take very strong sell signals, and I would only sell near the top. Okay, so you're getting a series of higher highs and lows, so it's clearly a bull trend, and I would only sell if I had a very strong sell signal, and I would not sell halfway down into the channel. After a weak leg up, you can, at a new high, you can sell below a strong bear signal bar, and you can sell below any bar, signal bar, if it's a second signal at a new high. After a strong leg up, don't sell unless there's a second signal. So a pretty strong leg up, I would not take that short. You can argue second signal, but the market opened down here, and I would have pulled my order before the open when I saw that it was going to open this far below the high. So what about selling up here? Arguably a second signal, first signal here, second signal there. I would not. You've got 2 very small doji bars, not a lot of selling pressure. I would not take the shorts. Okay, I mentioned that. To me, I would not sell down here. I would only buy. And as far as buying this bar, to me, I would only buy it for a swing, and my stop would be down here. it's too high above the bottom, and it's after 2 strong bear bars. So that's not a strong buy setup. Let's say you bought the open of the bar or the close of the bar, and the market gapped up on the next bar. You can determine your actual risk 1 tick below the low of this bar, and that's 2 times your actual risk. You could scalp out part there. And the market then entered a very tight channel. What about exiting up here? I don't know. You could take partial or full profits here. We poked above the top of a very tight channel, and we have a strong bear bar. But I think it's also okay to continue to swing part of your position. At this point, where's your stop? Probably still below the most recent high or low. And you can see that sell failed, and we got a triangle. 3 pushes down, 1, 2, and 3, and then a bull breakout. Once you have this bull bar, I would trail my stop to below this low or below this bull bar. And after this additional bull breakout, I'd put my stop below that low. And that is the end of the module on trading weak bull channels.